Let's break it down piece by piece. We're going to demystify the world of markets, stripping away the jargon and complexity to reveal the core concepts. Before we dive into the exciting world of trading, with all its potential and possibilities, let's start with the basics, the absolute fundamentals. This will give us a solid foundation to build upon. What exactly a market? What does that term really mean? Forget the images of Wall Street you might have in your head. Instead, think of something much simpler, something you might encounter every week. Your local farmer's market. Sellers bring their freshly picked apples. Buyers are there because they want those apples, maybe to make a pie or just enjoy a healthy snack, and through a bit of negotiation, they agree on a price that works for both of them. That, in its simplest form, is a market in action. Financial markets, while seemingly complex, fundamentally work the same way. The difference is that instead of apples, we're dealing with things like stocks, ownership in companies, or different currencies from around the globe, like the dollar, the euro, or the yen, or even raw materials and resources known as commodities instead of those delicious apples. The price of these assets goes up when there's more demand, when more people are eager and willing to buy, and it goes down when there's more supply, when more people are trying to sell. This dynamic interaction between buyers and sellers is called price discovery. It's the process that tells us what something is actually worth at any given moment in time. Financial markets are constantly doing this, assessing value for everything from crude oil to the shares of your favorite companies, updating those prices in real time, constantly reflecting the latest information and sentiment. So, the next time you hear the market mentioned on the news, remember that it's simply referring to this vast, global network of buyers and sellers interacting with each other. It's not some exclusive club or a mysterious, impenetrable force. At its heart, it's just people, like you and me, agreeing on prices and making deals. So whether you're buying a share of stock through an app on your phone or buying a brand new pair of sneakers, you're participating in a market, you're part of the economic ecosystem, and that's all there is to it. Now let's add a layer derivatives. A derivative is a contract whose value comes from something else, like stocks, oil, or currencies. You're not trading the asset itself, but a contract about its price. There are four main types: forwards, futures, options, and swaps. Forwards are private deals to buy or sell later at a set price. Futures are similar but traded on public exchanges and standardized for everyone. Options give you the right, not the obligation, to buy or sell at a set price. Swaps let two parties exchange financial obligations, like swapping fixed for variable interest rates. These tools let traders and companies manage risk or speculate on price moves. Why do derivatives exist? To transfer risk. Imagine a corn farmer worried about falling prices, and a cereal company worried about rising prices. They use a futures contract to lock in today's price, each protecting themselves from unwanted surprises. The risk doesn't disappear, it's taken on by speculators, who bet on price moves for profit. Speculators provide liquidity, making these markets work. Derivatives let people focus on their business, not unpredictable prices. That's the power of risk transfer. Let's see derivatives in action. Airlines buy oil futures to lock in fuel costs, protecting profits if oil prices spike. Jewelry makers use call options to secure gold at today's price, but only if prices rise. Chocolate companies use forward contracts with farmers for unique cocoa beans, ensuring supply and price. Companies with loans use swaps to exchange fixed and variable interest payments, managing borrowing costs. In each case, derivatives help businesses plan, protect profits, and manage risk. These aren't just abstract tools, they shape real-world decisions every day. Whether it's fuel, gold, cocoa, or interest rates, derivatives keep the wheels of commerce turning. They're essential for stability in a world of constant price changes. That's why they matter, and why you should understand them. Let's delve into the world of derivatives and explore a popular instrument known as the contract for difference, or CFD. It's a unique way to participate in the financial markets. With a CFD, you don't actually own the underlying asset, whether it's a stock, commodity, or index. Instead, you're essentially entering into a contract with your broker, betting on whether its price will move up or down. It's a speculation on price movement. For instance, if you believe Tesla stock is poised for growth and anticipate a rise in its value, you would buy a CFD. This is known as taking a long position. Conversely, if you anticipate a decline in the stock's price and it falls, you lose money on your trade. Your profit or loss is directly determined by the difference between the opening price when you initiated the contract and the closing price when you decide to close it out. This difference is then multiplied by your position size. which represents the number of contracts you've purchased or sold. One of the key characteristics of CFDs is that they use leverage, allowing you to control a significantly larger position in the market than the amount of capital you initially deposit. This deposit is known as margin. While leverage can amplify your potential gains, it's crucial to remember that it also amplifies both gains and losses. For example, with a leverage ratio of 10:1, a relatively small deposit of $2,000 empowers you to control a substantial $20,000 worth of stock. However, it's important to be aware that if the price moves against your prediction, the potential losses are magnified in the same proportion. CFDs have gained popularity among traders due to their flexibility and the ability to access a wide range of markets, all from a single trading platform. However, it's crucial to acknowledge that they inherently carry a significant level of risk. Therefore, it's imperative to approach them with caution and implement robust risk management strategies. Take the time to thoroughly understand the underlying mechanics of CFDs and the associated risks before you engage in trading. So, how exactly are CFDs different from other trading instruments you might encounter? It's a question many new traders ask, and understanding the nuances is crucial before diving in. We're going to break down the key distinctions to help you make informed decisions. Let's compare them to futures or options, two other popular forms of derivative trading. What sets CFDs apart in the world of financial derivatives? With futures contracts, there's typically a real underlying asset behind the contract. This could be anything from gold and oil to agricultural products. In some cases, sometimes you even take physical delivery of that asset when the contract expires. Imagine receiving barrels of oil at your doorstep. CFDs, on the other hand, are always cash settled. There's no physical exchange of goods. With a CFD, you never actually own the underlying asset itself. You're simply speculating on its price movement. Futures and options contracts are standardized instruments, meaning their terms are uniform. They are also traded on regulated exchanges, providing a level of transparency and oversight. CFDs, however, are private deals made directly with your broker, operating in the over-the-counter (OTC) market. This means your broker essentially sets the terms of the contract, including pricing and margin requirements. Futures and options contracts always have specific expiration dates, after which the contract is no longer valid. CFDs usually don't have an expiration date, allowing you to hold positions open indefinitely, but you'll typically pay overnight fees, also known as swap fees, to maintain those positions open each day. CFDs often let you trade in smaller sizes compared to futures or options, making them more accessible to traders with limited capital. CFDs also provide access to a wider range of global markets from a single trading account, offering greater diversification opportunities. However, it's important to remember that with CFDs, you take on counterparty risk. This means that, if your broker becomes insolvent or fails, you could potentially lose your investment. CFDs are generally designed with the retail trader in mind, offering a user-friendly platform and leverage. They offer flexibility and accessibility, but also come with a higher degree of risk due to leverage and market volatility. Therefore, it's crucial to thoroughly understand the differences between CFDs, futures, and options before you choose the right trading tool for your needs. Ultimately, it's about picking the instrument that best fits your individual financial goals and investment objectives, and of course your personal risk tolerance. Choose wisely. Why does all this matter? Because understanding markets, derivatives, and risk is the foundation of smart trading. Without this knowledge, you're just gambling. Knowing the difference between a CFD, a future, and an option shapes your strategy and risk. This knowledge protects you from costly mistakes and hype. As you learn about charts and strategies, remember these basics. Build your trading on solid ground, not guesswork. That's the key to long-term success.